On the Fed's move extending into the junk bond space and some huge support for municipal bonds as well.
Yeah, I mean, it's pretty, when you think about the fact that before Bear Stearns failed, 90% of the Fed's balance sheet, which is about $800 billion, was in treasuries. And you think about how far we've come in 11 years, it's pretty shocking. And I can't say I'm thrilled with it in a certain sense, in that, but I also think that it's necessary. I think the Fed's doing precisely the right thing, but theoretically, at least, unelected officials shouldn't be having such a heavy hand in the overall economy as a whole. I think that's very theoretical. By the same token, this is, as Chairman Powell said, this is a decision that this shutdown is largely being driven by government policy. And so by the same token, it seems only appropriate that the government would compensate or try to ease the pain that you're having on the economy as a whole.
Right.
But it's just, if you're a traditionalist, it's hard to feel really great about this because it seems like we're pretty far away from what the initial idea of the Fed was about 100, more than 100 years ago.
It reminds me also a little bit of prices at the gasoline pump, where they rise very quickly, but they fall very slowly. Brian, I'll turn to you on this. The Fed seems to be very quickly able to move very quickly, to help everybody and lend support, but it's very hard to unwind these programs once they've started. I guess from the investor's point of view, from the market side, they probably take that as a good thing, right?
Well, I think so. We go back to what we saw post the credit crisis, where the Fed got involved, and clearly TARP was designed at first for the banks. And if you take a look at when the market actually bottomed in March, financials outperformed for 6 or 7 months, and then for all intents and purposes were dead for 10 years. So is the same thing going to happen this time around with some of these companies that really the Fed came in to really help support, whether or not it's a cruise line or an airline or other kind of consumer thing? You have to really, that's where you have to really put your fundamental hat on, Kelly, and really see what the wherewithal of these companies are, going forward. We've been on record by saying we still think that the market made a bottom March 23rd. We still said in print that day that the market would rally 40 to 50% because we thought people were way too bearish and making these big depression type calls. But I think Jason made an excellent point. It's how we unroll this going forward. It's clearly not going to be anytime soon in 2020. This is a question of what happens in 2021 and 2022, and what and how the market digests that. But until then, we still think that this monetary and fiscal policy, the response has been very positive to refuel and build confidence back, not only to the consumer, but the stock market.
Right. And we saw the consumer confidence number was awful this morning, so they could use it. Brian, I want to ask you, because you said we had this sharp rally in the financials after 08, but then they were dead for a decade. Do you see similar trends playing out with the hardest hit sectors here? And I guess another way of saying the question is, where would you recommend investors be positioned? Can you own the S&P 500 index fund and be fine?
Well, we've never been big believers in terms of indexing in general. Part of our job also is to be a portfolio manager. So we clearly default to more active stock picking strategies. I would say this, for 20 years as a strategist, I've talked about how I think there's way too much capacity in consumer land. Maybe this is one of those situations where we take out some of these underperforming companies in consumer land that we don't really need anymore. Maybe we're going to see massive reworkings of how we consume money, Kelly, whether or not it's online or Costco or Walmart, and continue to be that type of strength. I think that the consumer never, ever, ever bet against the consumer's wherewithal, but bet against how these companies are going to make money going forward. And I think that's a very, very key component. So that's why, from a longer term perspective, we are still overweight communication services, discretionary, and technology with respect to our U.S. holdings for the next 12 to 18 months.
Okay. Jason, let me bring you in on that. And again, the Walmart and Costco comps have been fantastic, but I can tell you, even locally speaking, it's getting harder and harder to go to the supermarket. There's, the checkout line, just the whole experience. It's, if there were a way to avoid it going forward, I would. Something that Brian said I thought was interesting. He said for 20 years we had too much consumer capacity. Maybe now is the way to take that out, but not if the Fed's providing support writ large, right?
Well, I still think it will lessen the blow, but by the same token, it doesn't matter what the interest rate is. If there's no revenues, you still can't you don't have the cash flow to make the interest expense. So it will help larger companies with access to more permanent capital. I think that one of the things that will unfortunately be a part of this, and I know they're trying to move heaven and earth to help, which is appropriate, small and medium-sized businesses, local businesses that don't have access to that permanent capital. And there, unfortunately, as much as they're trying to help, the government is trying to help, you really are in a situation where it's very touch and go. A lot of these companies operate with very low margins to begin with. Again, they don't have permanent capital. And so it will be interesting, and we pray that a lot of those companies pull through.
Yeah.
If not, there's going to be an ability for companies that have access to these programs to consolidate a lot of excess capacity, particularly in the retail space.
Yeah, and that's another way maybe to think about it as an investor.